Today I'm going to talk about real estate. It's been a long time since I've been posting a video, so for those of you that are new, can you please like and subscribe, because this is going to be a 7-part series, and I'm also going to start covering some of my investments and my takes on Easy Equities. And if you are from SA Easy Equities Investors Group, thank you for tuning in, and please like and subscribe. And also, if you've got any opinions or any comments or any suggestions, feel free to post them in the comments. This vlog or series that I'm calling it is about real estate. So there are many types of investments. Some of them include investing in cryptocurrency like Bitcoin, Ethereum, Litecoin, Dogecoin. There are so many. Equity stocks like investing on the JSE, which is the Johannesburg Stock Exchange, where you can buy South African equities. You have equity options, which is platforms where you can basically betting on the outcomes of the direction of the market going up or down. Then there is real estate, and this is the one that we are discussing today. How to get into the real estate market. Before you can get into the real estate market, there are some things that you have to take into consideration. And for those guys that are about to acquire their first real estate property, this vlog is about what do you need to buy your first house or real estate property. Second one is your credit score or your risk score, the score that the banks keeping track of in the back-end systems. The third part of the series is going to be about property valuation. The fourth part is about ABC, closing the deal. ABC, always be closing, meaning the buyer and the seller, the buyer, you that are planning on buying a property, coming together with the seller and you pulling the trigger. Then there's timing. Some people believe that it's impossible to time the equity markets, meaning to time the stock market, when is the right time to buy and when is the right time to sell. And some people believe in the housing market it's impossible, but there are signals of when it's the right time to buy and when it's the right time to sell. Then number 6, the types of real estate. I'm going to be concluding with number 7, which is passive income, because there are active investments and there are passive investments. So what does active mean? Active means like you are running a full-time business and it requires your attention in the form of management, running operations, doing cash flow analysis, meaning the day-to-day running of the business requires active participation of the shareholder or the owner of the company. And then there's passive, which basically translates into it in relation to a full-time business. You are probably putting in a 10th or 100th of the managerial operational skills required to run a business day to day, a full-time business day to day. Without further ado, let's start today's part of how to get into real estate. So what do you need to acquire your first property? So number 1, obviously you need an income, because you can't buy a house with nothing. So an income, that means that the bank, if you are going to buy the house cash, good for you. I'm here to talk about how to acquire it with finance or assistance from a financial institution or an accredited financial institution. So number 1, you are going to need 6 months worth of bank statements, 6 months worth of payslips. So let's say, for argument's sake, you are banking with First National Bank, Capitec Bank, African Bank, and they are unable to supply you with a housing loan or a bond, or willing to finance your bond. So now you have to go to Standard Bank, Absa Bank, which are the two main banks with regards to financing bonds. Bonds meaning a house that is covered by the bank. There are also some other institutions like Uber that will also be able to supply you with finance for acquiring your first property. So now that you have your 6 months pay slips and your 6 months bank statements, you can go to the bank. You're gonna need a tax clearance certificate. So it's impossible to buy a house without paying your taxes. So tax clearance certificate tells the bank that you are paying your taxes, that SARS is not gonna come looking for you and take possession of your assets, which means that you are a high risk for the bank. If you are a business owner, you're gonna need 2 years worth of financial statements and a tax clearance certificate. So once you have these, you're gonna need an OTP. An OTP is an offer to purchase. So this means that you've seen a property that you liked, and then you called the real estate agent or the personal owner, depending on who advertised the property. So you can go on property24.com, or you can call the number outside of the house that you are willing to buy, and then you speak with the owner, and then you agree on the price, or you speak with the real estate agent, you agree on the price, and then the owner will issue you with an OTP, which is a legally binding sales agreement between buyer and seller. So now that you have your OTP, you can head off to the bank, your 6 months pay slips and your 6 months bank statements, and then an affordability assessment will be conducted. So some people might be earning already more than one income. The bank will consider both sources or 3 sources or more of income. So some people have side hustles. That's good news for you. You can use your Herbalife, your Tupperware, or whichever other side hustle income you have, providing that it's been consistently paying you for the past 6 months. So now you will have your gross income. So your 6 months salaries and your other income, your side hustle income, reflecting on your bank statement. So it's gotta reflect on the bank statement. So all of those payments will be circled, and then all of the sources of income, and then divide the average income over the period of 6 months, and then you will get your gross income. Now they need to deduct your operating expenses, your cost of living, meaning your utility bills, your internet services provider, your medical aid, if you stay in a high risk area, you might have security. If you have alimonies, if you are divorced and your wife has won a case where she laid claims on, she's entitled to an income as stated by the court or directed by the court, then those expenses need to be accounted for. If you have child support, all of those expenses will be accounted for. So your utility bills, your amount of money you spend on groceries, going to the hairdresser, it's the sum of the operating expenses. And then these operating expenses plus your other expenses you are paying to other credit services providers. You cannot lie about this information because it's already on your bank statement, and the bank can track this information on the Experian system, where they can see your outstanding balances and your payments, your minimum payments due to other financial services providers. And then it will give the bank the exposure, the affordability, the amount that you are able to pay. So let's say, for example, you are a husband and a wife. Now you can apply for a joint bond, meaning two people's incomes will be taken into consideration, or if you are single, then it will only be you. But in most cases, it would be a husband and a wife. Now that the bank has your affordability income, now they can calculate how much you qualify for. So this would mean that they would take into consideration the current prime interest rate. The current prime interest rate. And depending on your credit score, so your credit score is your risk factor, meaning the bank will calculate in the past 24 months how many times you have forfeited on other credit services providers and how much outstanding debt you have. If you have more than 80% 80% occupied in your credit cards, this is also considered highly risky. If you have more than 10 credit accounts, this is also considered very, very risky. So now that the bank has determined your risk and your affordability, they will proceed to the next part, which is, okay, you've been approved for the bond, you meet the affordability requirements. So now they can proceed to the next part, which requires you to put down a deposit. So if you are white or considered not previously disadvantaged, you will require a 35% deposit. So on 1 million, they would require a deposit of 350,000. If you are previously disadvantaged, it would be considered 30%, which is 300,000. And now the risk factor comes into play. So if you are white and you are looking at this 35% and thinking, oh my god, I don't have 350,000. Well, there's some positives to this. So the bank will consider your risk factor, and they will consider the property that you are buying, how much meat is in that property, if the price is overstated, or whether it's actually worth more or less. You are buying the property at a premium. So now your risk factor will come into play. So if you are low risk 1, and you have a credit score of like 900, which is basically the perfect score, what the bank is looking for. You haven't been forfeiting on any of your payments in the last 24 months. You pay your bills on time, sometimes even more than the minimum payment amount. You are considered low risk. You haven't applied for any unnecessary credits in the last 6 months, which they do pick up on. Then you are considered a low risk. If you are, just say, above 700, then okay, this I will discuss in the next vlog. I forgot. So that's with regards to risk. So that risk factor can now come into play, and the bank can say, okay, we can finance you 90%, 95%, or we can finance you 85%. So that would reduce the deposit that you would have to put down. And then there are also some attorney fees involved. My attorney fees on a 1.3 million rand property was plus minus 80,000 rand. I think it was 75,000 rand. In the calculations, we also have the commission of the real estate agent. So in your affordability assessment, you can factor in the period of time over which you're gonna pay your bond. It would be 20 years, 25 years, 30 years, or 15 years. Some people might even pay over a shorter period of time. Like in the past, people used to purchase cars over 3 or 4 year periods, but lately you can buy a car over a 7-year period with a balloon payment. So things do change over time, and you can purchase a house over 30 years, providing the bank deems you less risky to forfeit. So that is the stuff that you need. So to summarize everything, you need 6 months payslips, 6 months bank statements, and offer to purchase. If you are a business owner, then you're gonna need 2 years worth of financial statements and a tax clearance certificate for both individuals, joint, or the business owner. If you have a side hustle, then you're gonna have to provide your sources of income. So additionally to your salary payslips, you're gonna have to prove where you got your money from. So that would mean your Herbalife gonna have to issue you with some paperwork or your Tupperware. Then you're gonna need your deposit and the period over which you're gonna repay the bank. So that's it for part 1. Feel free to post any comments, any questions, and please don't forget to like and subscribe. Thank you for watching.
You see, stereophonic sound for the home is recorded on 2 separate tracks, each one giving